There is a number. It sits on a screen in a room full of men who don't sleep. When that number moves in the wrong direction, fast enough, far enough, everything you own becomes worth less. Your house, your savings, the retirement account you've been building for 30 years, the paycheck that was supposed to hit your account on Friday. Everything. And 4 times in the last 40 years, that number didn't just move. It fell off a cliff. 4 days. 4 moments when the entire financial system, the invisible architecture that keeps the lights on, keeps the food in the stores, keeps the planes in the air, nearly collapsed. Not almost. Nearly. These aren't cautionary tales from a textbook. These are the real hours, the real phone calls, the real faces of the people who were standing in the room when the world almost broke. And the scariest part? Most people have no idea how close it got. Day 4. October 19th, 1987. Black Monday. The 1980s were a party. Ronald Reagan was in the White House. The economy was running hot. Wall Street was minting millionaires faster than it could fit them into corner offices. The Dow Jones had climbed 44% in just 7 months. Every day was another record. Every broker was a genius. Nobody wanted to leave the dance floor. The week before October 19th had been rough, a 10% pullback from the peak. Rising interest rates, a ballooning trade deficit. Iran had just attacked 2 oil tankers off the coast of Kuwait, and a freak storm had shut down London's markets early on the Friday before. Some nerves, some grumbling. But rough weeks happened. That's what corrections were for. October 19th was a Monday. Traders showed up to the New York Stock Exchange the way they always did, coffee in hand, ties too tight. The opening bell rang at 9:30, and the world fell apart. Before a single trade could execute, 95 stocks on the S&P 500 were delayed. The order imbalance was so extreme, so many sellers, so few buyers, that the specialists on the floor couldn't even match the tickets. 11 of the 30 Dow stocks couldn't open at all. But the futures markets, they opened right on time, and they were already in freefall. Here's what happened next, and it happened fast. The computers kicked in. This was 1987, the era of portfolio insurance, a strategy that used automated trading programs to sell stocks when prices dropped past certain thresholds. It was supposed to protect portfolios from losses. In theory, it was brilliant. In practice, it was a loaded gun pointed at the market's head. Prices dropped. The computers sold. The selling pushed prices down further, which triggered more computers to sell, which pushed prices down further, which triggered more computers. A feedback loop, a mechanical death spiral. And nobody could stop it because nobody was driving. The machines were. By noon, the Dow was down over 200 points. Phone lines at every brokerage in America were jammed. Millions of ordinary people, teachers, retirees, small business owners, were calling their brokers and getting nothing. No answer. No trade. No information. Just a busy signal while their life savings evaporated in real time. By 3 o'clock, rumors started flying. The New York Stock Exchange might shut down entirely. The clearinghouses in Chicago might already be insolvent. Nobody knew what was real and what was panic. And in a market like that, the panic becomes the reality. When the bell rang at 4 o'clock, the number on the board was almost impossible to believe. The Dow Jones Industrial Average had fallen 508 points, 22.6%, in one day. To put that in context, the worst single day during the Great Depression crash of 1929 was 12.8%. Black Monday was almost twice as bad. $500 billion in market value. Gone. In 6.5 hours. And it wasn't just New York. The crash had started in Hong Kong before the sun came up on the East Coast. It tore through Tokyo, ripped through London, down 14% before the American markets even opened. Australia's stock market would eventually lose over 40% of its value. New Zealand's would lose nearly two-thirds, $1.71 trillion in worldwide losses, in a single day. That night, the men running the Federal Reserve sat in a room and faced a question nobody had prepared for. Would the American financial system survive until Tuesday morning? Margin calls were coming due, demands for cash that brokerages didn't have. Banks were refusing to lend. The clearing system was seizing up. If the banks didn't lend, the brokers couldn't settle. If the brokers couldn't settle, the whole thing, the entire chain of trust that the modern economy depends on, would snap. The new Federal Reserve Chairman, Alan Greenspan, just 2 months into the job, released a single sentence the next morning. One sentence. The Fed stood ready to serve as a source of liquidity to support the economic and financial system. One sentence. That was it. Behind the scenes, he was personally calling every major bank CEO in the country. Lending. Keep lending. Whatever they need, keep the money moving. Do not let this freeze. It worked. The market bounced back 288 points over the next 2 sessions. Within 2 years, it had fully recovered. The recession everyone was certain was coming never came. But nobody knew that on October 19th. On the night of October 19th, 1987, the smartest people in finance thought they were watching the end. And the machines that were supposed to protect them were the ones pulling the trigger. Day 3, September 15th, 2008. The Lehman collapse. It's a Sunday night in September, and inside the headquarters of Lehman Brothers, 745 7th Avenue, Midtown Manhattan, people are packing boxes. Not files, not case studies. Their things. The framed photos on the desk, the coffee mug from their kids' school, the little things you collect over years at a job where you gave everything. They'd gotten the call. The deal was dead. Barclays had walked away. Bank of America had bought Merrill Lynch instead. And the government, the same government that had bailed out Bear Stearns 6 months earlier, looked at Lehman Brothers and said, no. At 1:45 in the morning on Monday, September 15th, the 158-year-old firm, a company that had survived the Civil War, the Great Depression, 2 world wars, and September 11th, filed for Chapter 11 bankruptcy protection. $613 billion in debt, the largest bankruptcy in American history. Dead before breakfast. When the markets opened, the reaction was instant. The Dow dropped 504 points, its worst day since the September 11th attacks 7 years earlier. Lehman's own stock lost over 90% of its remaining value in a single session. But the stock drop was almost beside the point. What was happening underneath, in the machinery that most people never see, was the real nightmare. Lehman wasn't just a bank. It was a counterparty. It sat at the center of a web of over 900,000 derivative contracts with a notional value north of $35 trillion. That's not a typo. 35 trillion. Roughly 5% of the entire global derivatives market ran through Lehman Brothers' books. And now, overnight, nobody knew what those contracts were worth. Nobody knew who owed what to whom. The entire system of trust that holds the financial world together, the assumption that the other side of every trade will pay up, cracked wide open. The interbank lending market froze. Banks stopped lending to each other. When banks stop lending to each other, credit stops flowing to everyone, to businesses, to consumers, to the guy trying to buy inventory for his hardware store and the family trying to close on a house. It froze. The next day, the Reserve Primary Fund, a money market fund that was supposed to be as safe as a savings account, announced it had broken the buck. For every dollar investors had put in, they now had 97 cents. 3 cents doesn't sound like much. It was enough to start a bank run. Within 48 hours, investors ripped $144 billion out of money market funds across the country. $144 billion in 2 days. The government scrambled. The Fed seized AIG, the insurance giant, with $85 billion in emergency funding the very next day. AIG had sold insurance on so many of those toxic, mortgage-backed securities that if it fell, it would drag every bank on earth down with it. Washington Mutual, the largest savings bank in America, was seized by regulators 10 days later. Biggest bank failure in U.S. history. Gone. Congress rushed through a $700 billion bailout package, the Troubled Asset Relief Program, TARP, emergency measures that nobody in Washington wanted to pass, but everyone knew they had to. In the 6 months that followed Lehman's collapse, global stock markets lost more than $10 trillion in value. The Great Recession had begun. 20 million Americans lost their jobs. Millions lost their homes. Retirement savings, built over decades, erased. And Richard Fuld, the man who ran Lehman Brothers, had collected $484 million in total compensation in the years leading up to the collapse. When he was dragged before Congress and asked if that was fair, he said Lehman Brothers was a casualty, not a cause. A casualty. The employees who packed their boxes on that Sunday night in September, the ones carrying their picture frames and coffee mugs past the TV cameras in the dark, they got nothing. Fuld still has a mansion in Greenwich, Connecticut. Day 2, May 6, 2010. The flash crash. This one is different. Black Monday was about greed. Lehman was about recklessness. This one is about something else entirely. This one is about what happens when we hand the financial system to machines, and the machines turn on each other. It was a Thursday afternoon in May 2010. The trading day had been tense all morning. Greece was drowning in a debt crisis that was threatening to crack the European Union in half. Markets were already down about 4% before lunch. Liquidity was thin. Traders were on edge. But nothing unusual. Nothing that should have ended the world. At 2:32 in the afternoon Eastern Time, a trading algorithm activated. It belonged to a mid-sized mutual fund based in the suburbs of Kansas City, a firm called Waddell & Reed. Not exactly a name that strikes fear on Wall Street. The algorithm's job was simple. Sell 75,000 E-mini S and P futures contracts, about $4.1 billion worth, a hedge, a routine risk management move. But the algorithm had a flaw that nobody had stress-tested for a day like this. It was programmed to sell based on trading volume, not price. It didn't care what anything was worth. It didn't pause. It didn't recalibrate. It just sold. Into a market that was already bleeding. The high-frequency trading firms, the machines that execute millions of orders per second, started absorbing those contracts, and then immediately selling them right back. The same contracts bouncing between machines at a speed no human could follow, the price dropping with every pass. By 2:42, 10 minutes in, the Dow was down 300 points. In the next 5 minutes, it fell 600 more. 900 points. In 15 minutes. And then it accelerated. At 2:45, the Dow hit the floor, down 998.5 points. Nearly 1,000 points wiped off the board in 20 minutes. $1 trillion in market value. Gone. Vanished. In the time it takes to order lunch. Across the country, on trading floors, in offices, in living rooms where people had CNBC on in the background. Screens were showing things that couldn't be real. Accenture, a company worth tens of billions of dollars, was trading at 1 cent per share. 1 cent. Sotheby's, the auction house, briefly traded at $100,000 a share. Procter & Gamble, one of the most stable companies on the planet, the people who make Tide detergent and Gillette razors, dropped 37% in minutes. Jim Cramer was on air watching it happen live. He was shouting at his own crew, "That is not a real price. Just go buy Procter & Gamble right now." And then, as fast as it started, it stopped. By 3 o'clock, the market had recovered 600 points. By the close, the Dow was only down about 348 points. Almost normal. Almost. But what had just happened was not normal. In 20 minutes on an ordinary Thursday afternoon, a single algorithm, running out of a building in suburban Kansas City, had nearly destroyed the financial system. Not a rogue trader, not a corrupt bank, not a war. A computer program executing a sell order that nobody was watching closely enough. Investigators spent months untangling it. They blamed the Waddell and Reed algorithm. But then they found something else. A man named Navinder Sarao, a trader operating out of his parents' house in Hounslow, West London, a bedroom, a laptop, an algorithm he'd built himself to spoof the market, flooding fake orders to manipulate prices, then canceling them before they executed. One man, one bedroom, $1 trillion. They arrested him 5 years later. By then, it had already happened again. Smaller flash crashes, faster, harder to explain, ghosts in the machine. The financial system had become something no human designed and no human fully controlled, and nobody wanted to talk about what that meant. Day 1, March 16th, 2020. The COVID collapse. The world had never shut off before, not like this. By the second week of March 2020, the dominoes were falling so fast that nobody could count them. The NBA had suspended its season. March Madness was canceled. Schools were closing. Restaurants were going dark. Airlines were grounding entire fleets. Italy was in full lockdown. The president went on television and told the country it could last until the summer. Nobody knew how bad it was going to get. That was the part that made it different from every other crisis on this list. In 1987, the threat was inside the machine. In 2008, it was inside the banks. In 2010, it was inside the algorithms. In 2020, the threat was everywhere, in the air, in your lungs. On the door handle you just touched. You couldn't model it. You couldn't bail it out. You couldn't issue a one-sentence statement and make it go away. Monday, March 16th. The New York Stock Exchange opened for business. The sell orders were so overwhelming that the market tripped a circuit breaker before the opening bell had finished echoing. The S&P 500 fell 7%, the trigger threshold, in the first minutes of trading. All exchanges across America halted. 15 minutes of enforced silence while traders stared at frozen screens. It was the third time in 8 days that circuit breakers had fired. These were mechanisms that had been used exactly once in the previous 23 years. Now they were going off like smoke alarms in a burning building. When trading resumed, the selling didn't stop. It accelerated. By the close, the Dow Jones Industrial Average had fallen 2,997 points. Nearly 3,000 points in a single session. 12.9%. The second worst single-day percentage loss in the Dow's entire history. Worse than any day in 2008. Worse than any day during the Great Depression. The only day that was worse was Black Monday, 1987. The S&P 500 lost 12%. The Nasdaq lost 12.3%. The worst single day in the Nasdaq's history. Every stock market on Earth was collapsing at the same time. London down nearly 11%. Germany down 12%. Italy, the country being ravaged worst by the virus, down nearly 17%. In one day. The VIX, the fear index, hit 82.7, the highest since the 2008 crisis. The market's way of saying, nobody knows what anything is worth anymore. There was no playbook for this. No model, no precedent. In 1987, the Fed could call the banks. In 2008, The government could write checks. In 2010, they could pull the plug on the algorithm. In 2020, the economy wasn't crashing because of a mistake or a fraud or a software glitch. It was crashing because the world was physically shutting down. Factories were closing. Supply chains were severing. People were staying home because going outside could kill them. The Federal Reserve slashed interest rates to zero in an emergency Sunday night announcement, the first time since 2008. They launched $1.5 trillion in emergency lending. They announced unlimited purchases of Treasury bonds. Congress passed a $2.2 trillion stimulus package, the largest in American history, and the market kept falling. The S&P 500 wouldn't bottom out until March 23rd, down 34% from its February high. The fastest bear market in history. 23 trading days from an all-time high to a 34% collapse. 20 million Americans lost their jobs in April alone. 20 million in 1 month. And then something happened that nobody could explain. The market came back. By August, the S&P 500 had fully recovered. By November, the Dow crossed 30,000 for the first time in history. By the end of 2020, the worst year in a generation for human beings, the stock market finished up 15%. 15%. In the year of the pandemic, people were dying, businesses were gone, entire industries were on life support, and the stock market was at all-time highs because the government had pumped so much money into the system so fast that the market stopped reflecting the economy. It was reflecting something else, something nobody fully understood, a machine that had disconnected from reality, and it hasn't fully reconnected since. 4 days. 4 moments when the machine almost broke. Black Monday showed us what happens when we let computers trade faster than humans can think. Lehman showed us what happens when we build a system so interconnected that one failure pulls everything else into the hole. The flash crash showed us that a single algorithm on a single afternoon can erase $1 trillion before anyone understands what's happening. And March 2020 showed us that no circuit breaker, no bailout, no emergency statement is built for a threat that comes from outside the system entirely. Every time we said we learned our lesson, every time we built new rules, new safeguards, new walls, and every time the next crisis found a crack nobody thought to cover. Because here's the thing nobody wants to say out loud. The global economy doesn't run on math. It doesn't run on regulations. It doesn't run on algorithms or interest rates or stimulus packages. It runs on belief. The shared, fragile, unspoken belief that the number on the screen tomorrow will still be close to the number on the screen today. That the money in your account is real. That the system will hold. And 4 times in your lifetime, that belief cracked. The question is not whether it will happen again. The question is whether you'll be ready. Because the people who understood what was happening in each of those 4 moments, the people who had studied the history, who had seen the patterns before, who kept their nerve when everyone around them was panicking, those were the people who came out the other side. Every one of these crashes ended. Every one of these markets recovered. The question is, where were you standing when it did?